Hi everyone, it's your daily 10-minute business and finance news wrap for this Monday, the 23rd of May 2022. Later, what a Labor government means for share markets. But first, the implication of the federal election outcome on your tax and on property. And let's start with tax, because it seems like a Labor government won't necessarily impact taxes at this stage. The so-called stage 3 tax cuts have already been legislated under the previous government, which will see everyone earning between $45,000 and $200,000 pay 30% in tax from 2024. The low and middle income tax offset was also locked in, which effectively means a tax increase next year when it ends, and negative gearing remains. Labor scrapped plans to ditch it after its 2019 election loss. Where there will be changes is for first home buyers. And for more on that, I spoke earlier with Michael Croker. He is the tax lead at the Chartered Accountants.
Yes, it's called the Help to Buy scheme. It was announced by the Labor Party in the lead up to the election. And it's designed to help those Australians who can afford at least a minimum deposit of 2%. So once you've got your 2% saved up, you apply to the Labor government, and it's an equity contribution. So if you're purchasing a new home, the Labor federal government would take up an equity stake of up to 40%. If you're purchasing an existing home, the federal government would take up an equity contribution of up to a maximum of 30%. Now, there's only 10,000 places available under this Help to Buy scheme, and we haven't got the fine detail yet. But the other restriction is depends on where you buy. If you're buying in the hot Sydney market, you're up to a maximum price cap of $950,000 for the 40% equity. That's the new home. And in Queensland, the maximum price cap is $500,000, for example. So you'll have to look at your own state rules to determine what the maximum price cap is for the house that you're going after. And the other thing is you have to be at least 18 years of age. And if you're an individual buyer, the maximum that you can earn in terms of what I assume is going to be your taxable income is $90,000. And if you're a couple looking for your first home, your maximum combined income must be $120,000 or less. And it has to be a property that you live in. It's not something that you use to enter the rental property market. It has to become your principal place of residence, and it has to be in Australia. And don't forget, even if you benefit from this scheme, you still have to find the money for stamp duty and legal costs and bank fees, etc.
Is it a step in the right direction in terms of housing affordability, do you think?
Yes, we support it. It's actually a scheme which is already in use in some Australian states, and it's also copied from I think the United Kingdom has a very similar program. So it's different to what was the Coalition's model. Their policy would have seen you accessing your superannuation, and as you may recall, that was criticised quite a bit for perhaps resulting in reduced retirement incomes. A lot of people said, well, that's not what superannuation's for. You shouldn't be eroding your superannuation balances to buy a house. Whereas this program, it's the federal government that takes an equity stake in the property. That said, there's also some downsides here. If the federal government's got some equity in your home and you make a profit on that home when you sell it, the government wants its equity back, and if you've made a capital gain, it presumably wants a little slice of that capital gain as well. So we haven't seen the fine details yet. Labor has indicated that it will have a budget statement perhaps in October or earlier in 2022. So we expect the public officials will be helping the the new Labor government designed this program, and we expect to see a lot more information about it in the coming months.
Michael Croker there from Chartered Accountants. Now to the Australian share market. The ASX 200 rose, but only slightly by 0.04%, 7,149. That's despite a solid start. For more, I spoke earlier with Luke Laretive from Seneca Financial Solutions. Luke, the market opened stronger, but then turned negative. But this had more to do with news out of China today than the election, didn't it? What exactly happened?
Yeah, I think so, Ricardo. The ASX was up a bit over 70 basis points in early trade. And as the Asian markets opened at about 11 a.m, we saw technology names in particular sell off both in Hong Kong and Shanghai, with higher COVID numbers coming out of Beijing, spooking investors, and those markets falling a bit over 1%. Our markets sort of followed suit. And as a result, some of our technology names were down. And some of the high beta growth stocks as well, as fears of further lockdowns, extended lockdowns, and slower growth out of that region leaks into Australia.
Okay, let's talk about the federal election. Overall, what do investors think about a Labor federal government, and how will it impact the markets?
Today it hasn't really impacted the markets too much. And I think from a policy perspective, there hasn't been a lot of, effective policy or change announced at the moment. So markets are treating the election fairly benign at the moment, and not much really happening. I think maybe some of the minimum wage rises that have been proposed by Labor might impact some of those companies that do have large wage bills and a big workforce. So the mining contractors and the healthcare companies kind of spring to mind: Worley Parsons, Ramsay Healthcare. But I think more broadly, not been a huge concern, the outcome of the election.
The government will still have to deal with some macro issues. So you've got the war in Ukraine, but the big one is that inflation rate, which will mean higher interest rates. So where do you see the opportunities for investors right now?
I think, inflation expectations have been accelerating, into the election and for the large part of this year. And that's seen value names and some of the resources sector really outperform. I think we're starting to see those expectations slow and growth slow a little bit now, which should see some of those same trades that have done very well start to unwind, and perhaps some of the growth names that we've seen sell off 20, 30, 40% in some instances start to do a little bit better and be a bit more valued by investors. I think if we are going to be in a low single-digit GDP growth, rising rates kind of environment, if you're a business that can grow double digits, sustain your margins, grow your profits, and do so while winning market share in whatever sector it is that you operate, you're going to be a highly prized commodity for investors, as you have been for the previous 10 years realistically, while rates have been on the decline. So I think we certainly trend for rates and trend for inflation is definitely still higher, but the rates of change might be slowing down a little bit, and we might see the bond market start to rally, and that could be good for some of these growth names that have been belted.
Luke Laretive there from Seneca Financial Solutions. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.